to another daily plan. This one's titled End of Week Plan. We're in the middle of the week. It's the hump day. It's also the FOMC day. We had a lot of expectations met in just the last few hours. During last week, we made our forecasts and we timestamped them with these arrows. We set our expectations for the week ahead on March 15th. And by the way, if you hear any humming in the background, there's people gardening out in the front around the neighborhood, and they're taking a really long time. So sorry if you hear a hum in the background. I can do about that. Anyways, we set up these expectations, and on a lot of these charts you'll see today, if you aren't familiar with watching these streams, we timestamp these drawings, not so that you can say, oh, look, I'm so right. We want to learn from our expectations. We draw these way in advance. You can see they're timestamped for last Friday. And whether these are right or wrong, and very frequently I can be wrong. I mean, February I was kind of bang on a lot, but then here's the beginning of February, so it's not like these drawings are always correct. I mean, look at that. That was when we did the month ahead expectation. This is why it's important to set expectations and be able to review over time as you acquire new information, how those expectations should change over time. And you can actually see the progression of, hey, the shorter term expectations tend to generally be more accurate than some longer term expectations. But man, oh man, is it sweet when you set an expectation for how the month is going to bottom or top out and close, and you just nail it. It follows a nominal path that you set at the very beginning of the month, and you feel like a wizard. But we're not all wizards, and guess what? The markets are chaotic, which just means sometimes they're predictable, sometimes they behave randomly. That's all chaos means. Sometimes it's predictable, sometimes it's random. And the further out in time you go, generally the more randomness you have to factor in over the longer time horizon. And when you have shorter time horizons, well, guess what? Those kind of movements can be anticipated a bit more accurate. Just a bit more. However, you can always get a surprise. Now, today with FOMC, I'm not going to review it today because I did a whole hour and a half long stream today with Ivan FX going over all my expectations. Ivan was very generous in giving me a lot of room to speak. I know he was, quite tired, frankly, towards the end of that. But I see chats coming in. Don't worry, I'm not reading those quite yet, but I'm seeing them come in. Thank you very much. But yeah, I'm not going to go over all my expectations of what I was thinking leading up into FOMC today. I've talked about it in the trading group. I've talked about it one-on-one with a lot of guys. I'm kind of sick and tired of talking about it right now, to be frank. What I'd like to do is just focus on reviewing what has happened so far, how they line up with what our expectations were before FOMC, and how the new information we got today from FOMC influences our future expectations going into the end of the week and into the following week. It's important that as soon as new information comes up, you try and update your expectations as quickly as possible so then you can set some new expectation of what's going to happen next. Always try and factor in new information as quickly as possible so that then you can check yourself. Again, this data is technically nominal. It came out as expected. We got risk on. I mean, I had some rants back here about uh, CPI, and how everyone and their mother was like, oh my god, the world's gonna end because CPI came in just a little bit hotter. And then PPI came out and surprised super high to the upside. And I gave 2 rants in 2 streams way back here. And the moral of the story for those streams was you do not commit to significant bullish or bearish expectations until you see the data. And that view was iterated by Powell. And believe it or not, it's iterated by a lot of professional traders. It's iterated by a lot of other central banks. You don't want to try and commit super hard to a position like all the bears were back here, right? You can see how this trade worked out. I just FYI, I didn't take this trade. We'll go over a couple of the trades that I took here. And they weren't all successful. By the way, we're going to be going over some trades that actually weren't successful. But then how did I risk manage those trades? What was I looking for with these indicators that I've built to help inform me that I needed to switch my position? I'm a bit, to be frank, a bit all over the place. So let me start with this chart here, the DXY. So FOMC comes out, they come out dovish, the nominal expectations are met. We've nailed this upward expectation. This right here with the line and the arrow up, this is me kind of drawing a contingency, saying, hey, above this line, I'd expect more upside. And you'll actually see in a little bit here how a couple of assets actually reached these sort of lines and didn't fall through. The other thing is you can also see for the week, this is a peak in your probability distribution, right? You can see this little red part of the histogram. This is where you have a higher density of tops for the week coming in. And yeah, there you go. This is really close to a peak high in the distribution. And that's one of the reasons why we drew this little line here. You can see the probabilities get really grayed out, really transparent, and you can view the numbers here on the right. To zoom in there a little bit extra for you. You can see these numbers are very big. This is 5.8, 4.8%, 3.6%. But now you notice as I go higher, they go lower. But then once you get up here, they start increasing a little bit. So the expectation with this sort of indicator, these sorts of probabilities, is you go from when you start to trade in a low probability spot, the nominal thing is to go to the next highest probability spot. So that was the expectation if we started crossing above there. But we didn't here on the dollar. We did in a couple other assets like the Aussie dollar. Right? We did that. We crossed below. And I know it's a bit hard to see because it's like red on red background. One of the things I can actually do here is hide the chart data. So you can see we have our little line here, time stamped. And note the timestamp on this is actually 3 days later. This was on the 18th. So this was here on Monday. We drew this line here and we drew this line here saying, hey, below this line, I'd start to get concerned about going lower. And that expectation is actually set using this indicator. We have this probability gap right here using seasonal data. And it's kind of the same idea. You start trading into a low probability spot. And the next most likely thing is to trade where the next kind of cluster of probabilities is past that. But in this case, look at that. So in the last 21 years of data for this particular week, the 12th week of the year on Aussie dollar, in the last 21 years, we've never had a low in these two spots. And now we've made a low for the first time in 21 years here. wow. And you can actually see this short drawing here. I actually did take this trade. And real quick, I'm actually going to go over how I got out of this thing, because you can clearly see that would have been a real bad loser. So what I did is I actually used the yield spreads. I'm going to go to a smaller time frame here. The yield spreads is this indicator right here at the bottom. So you see how all this red is here in this table, and you have these hamburger looking bars right here. These are all spreads of different yield durations. And right here is just a bar color coding that summarizes the data in the lower part of this chart. So there's kind of three different ways of viewing the data here. You can just look at the color on the bars. You can look at the minute individual measurable changes here. And you can have this little graphical representation of what the data in this table is actually doing. Yeah, this is something that a lot of people model FX prices with. So what I wanted to do is go on to this smaller time frame and use the replay mode to see, hey, look, we went from a lot of red to starting to see some green here on the yield spread. Going into FOMC, the yield spreads started to improve significantly. And so I looked at that, I'm like, I'm out. Because in my time trading and using yield spreads for an indication of future FX movements, it's a known thing. There's tons of articles about this over like the last 40 years. Whenever I see a shift in the yield spread going into a major economic event, most of the time, unless there's a surprise during the economic event, unless there's like a major surprise, I've experienced that this thing usually is right in the direction it points. So I see this faster moving part of the indicator flash green. I'm out. And then, boom. Saved my butt. Saved my butt. So that's how I saved my butt on that one. And in the trading group, I documented it live as I was doing that with the whole thought process. So that was a nice and easy little thing. But as I exited this trade, I'm like, well, if the yield spreads are increasing here, let me go ahead and check some of the other dollar pairs and see where the yields are increasing there. So I checked out New Zealand. I checked out all the dollar pairs. Long story short, Euro dollar had the best, most positive yield spread. And one of the interesting things about Euro right now is that the flash PMIs are coming for the Eurozone. And the flash PMIs are a leading indicator of so many macroeconomic indicators. They're used as features for modeling a ton of stuff. I know I say that a lot, but I only say it so much because it's, it's true, and not a lot of people are familiar with like what this data is really used for. So I find it worth repeating. So bear with me. So with these flash PMIs coming out, as a quick review, the last time the flash PMIs came out back in February, we did pretty well. I think it was somewhere around here. We got a spike higher because specifically the French flash PMIs really surprised to the upside. Like they were gangbusters. Really huge surprise to the upside. Now, the PMI data is compiled by a group called IHS Markit, which was required, I think, a year or two ago by S&P Global. So S&P Global compiles now and distributes the PMI indices. Well, every single week, every Friday, they release a weekly outlook. And in last week's outlook, they're not talking about a review of what's happened during the week. They're talking about what's going to happen in the next week. So every Friday, you get a document that tells you what their expectations are for the next week. So then you have like the whole weekend to think about it. You're not rushing to conclusions about what other people in the market are thinking about this or that event. Nothing's really sneaking up on you unless it's a surprise or an asset you're not familiar with or an economic event that you just weren't tuned into, frankly. Which is why you want to learn as much as you can about the assets that you're trading and things that can move it. And that comes with experience. Don't get me wrong, it's a long process, but you know, it's not like any guru is going to be able to sell you a course that tells you everything about markets. Nonetheless, you probably, even if you learned everything about markets, good luck applying it all without spending tens or hundreds of thousands or millions of dollars trying to acquire the data and the help and the personnel to implement all that information you've acquired. So for retail guys, reading outlooks is fine, and technical, some basic statistical analysis, reading expectations from professionals, that's the route most retail guys go. When it comes down to these expectations from S&P Global from last week, they said, hey, the French PMIs did great, the flash ones. And the difference between flash and headline PMIs, by the way, Ivan actually corrected me on this today. The flash PMIs are reported when 80% of the PMI survey has been completed. So when 80% of respondents to these PMI surveys are in, they release the flash PMIs. So the difference between the headline and the flash number is that little 20%. So yeah, that 20% sometimes can be volatile and deviate quite a bit. But most of the time, those headline numbers are going to be roughly in line, at least directionally, most of the time, with the flash number. And that's why a lot of people actually sometimes prioritize what the flash PMIs are doing. Because PMIs, again, are a great forecasting tool for a lot of macroeconomic indicators like GDP and inflation, which, if you were listening to Powell today, are kind of the two major, most important things. Also, employment and wages. Yeah, those things are kind of important. And the PMI indices can help with those forecasts as well. So, enough of like going over more of the basics. Let's get into more of the expectations. The expectations are good and optimistic going into the flash PMIs coming out here for Europe. So I actually think Eurodollar has quite a bit more upside left going into the end of the week, and I think it's going to exceed our nominal expectation. And you can actually see our nominal expectation from last week here. You can see this down line. Looks like we were about 1 bar off and about 20 pips off from the low there. So this expectation, I'd say, is kind of within error. That's a good expectation in my book. And this was a good expectation there. And you can see this is the threshold of like, hey, if shit really hit the fan here, this is kind of the line in the sand that I'm worried about still going below and reaching even lower levels. And we had bearish yield spreads here, so I was like, I'm very cautious here. And then I saw the yield spread start to improve going to FOMC. I'm like, okay, the expectation for 75 basis points of rate cuts during 2024 is getting moved into on these markets. That's the expectation. So flip, one risk on, nice. And I already was risk on going into the PMIs before FOMC. So this is just icing on the cake. This is revenge for last week's PPI, because I was long over here, and I had to get out at, don't get me wrong, I got out when it was green, but this put a sour taste in my mouth, having to get out around here. Like, do I really have to? This is a nice little bit of revenge on that PPI. Nice. And hopeful, very hopeful about the flash PMIs. Again, if those flash PMIs don't turn out well, I am going to flip fast. When new information comes out, update your expectations. Simple as. It's just a lot of the time, see, for retail, setting expectations and doing good risk management is really, really important to do ahead of time. Because when these events actually release, you are against the clock and against the order book of billions of dollars that are trading on robots that are way faster than you. So for retail, having expectations is a lot more important, especially if you're also discretionary. And expectations are a flawed tool in a lot of respects for people who are just getting into trading, because you have to know a great deal of stuff to set consistently good expectations. But at least here, you're encouraged to, even if you're bad, to set expectations, so that then you're motivated when your expectations aren't met to do more research and to look back and see why your expectations weren't met. And you do that week after week after month, and eventually you're going to be setting really good expectations that line up with the market, and you're going to be aware to all sorts of extra risks that the average retail guy is just not going to know about, because they don't put in the time. They don't know, I got to set expectations. Let's see here. How are you looking to trade for next week? Don't worry, I'll get to your stuff, crypto. That's actually going to be a major theme here. I know going into the end of the week, I'm going to be generally risk on for a lot of these assets. I mean, look at all these equity indices. Everything's up. The Russell did really, really well today. So did the NASDAQ. The world is doing really, really well. I think the yens are going to be dicey, to be frank. So please do like loads of research on yens. Like, I think yens are particularly risky right now, because I mean, look how high this thing has gone. I mean, all my expectations have been wrong on this thing. So I know there are some people who are really, really good at setting expectations on yen pairs, and then they go ahead and they look at these colored bars from the yield spread, and they're like, oh my god, how could you be so wrong? This indicator is telling you what to do. Green here, red here, green here. It's just so straightforward, right? Well, you don't always expect such crazy moves, right? And this is the part about being honest about your expectations. I'm not the best at setting expectations on the yen, even when I have these indicators. And the proof is right here in front of you. Like, that's just how it is. Over time, as I do more analysis, I'll get better, because that's what I'm trying to do by setting these expectations. I'm bad now. It doesn't mean I won't get better as I do more of this stuff and I learn more. And as we change regimes fundamentally with the BOJ and Japanese inflation and Japanese demographics, there's all sorts of ways this asset class can develop that need to be watched and that you need to be readily informed on. I mean, at these prices, the Ministry of Finance can easily come in and put the kibosh on this and just say, we are intervening, we are going to push the yen into some strength here. Like, these are sketchy places to be with Japan and the very heavily managed economy that it has. I'm so pissed off because of the BOJ. They always disappoint me. I still have to wait so long. To long JPY said. Yeah, the consensus from the Japanese outlooks that I've seen so far is everyone expects yen to get stronger. They just don't know exactly when. There's no clear consensus on the exact timing of yen strength at the moment. And the reason why a lot of people kind of got sideswiped on the BOJ is because while they did hike their rate, it wasn't a very big move when you actually look at the absolute value of it. And behind that rate hike, they did all sorts of stuff with different facilities for their bonds and their equity holdings, saying, oh, we'll buy more if we need to. They were actually quite dovish as they were hiking into that, trying to keep things very balanced. But I think they overdid it, frankly. So I think going forward, the BOJ is going to get a bit more hawkish. So I'd look at the economic calendars right now and try to pinpoint when the next speeches are coming out from members of the BOJ, just in case they start to get a bit more hawkish because they don't like this exchange rate price right now. And I know some people will say that analysis is quite flippant, but I mean, you want to listen to what the people at the BOJ are saying. And if they do get more hawkish going forward to try and push this thing down, a lot of people who follow Japanese economics closely for equities and the currency really study what every single member of the BOJ thinks and is positioned and is biased. Like, if you want to specialize in yen, you got to know those things to the best of your ability. You don't need to go totally overkill. You just need to do enough research to understand, okay, what's the consensus view? What do these people think? What are the economic indicators informing them that they should be doing? That sort of stuff. And again, that's retail, that's discretionary. There are guys who build models to try and automate this stuff. It's not in everyone's skill set to do that. And sometimes going to your bank and reading outlooks from your bank on these topics is, frankly, sometimes the better thing to do because you're getting expert opinions from people who are regulated to say, hey, here's our expectation going into these events and here's why. And let's go over all of our proprietary data and, proof that we have of why we hold this view. And in doing that and in reading that, you become more informed. So then when you read other outlooks from other institutions and other banks that you're a part of, you can go ahead and understand more and more and more of those reports. It's really important to understand what other people in the market are thinking to help set expectations. You want to know what the nominal or consensus expectation is going into an event. So then if there is a surprise to the upside or the downside, you can think for yourself really, really quick what the implication of that is for the asset that you're trading. Completely autonomously. No trading guru required. All right, let's see what. Hey, buddy, I got your stuff now, crypto. Could you help me out with Gari network. But no, dude, I already told you I'm not doing research on that. Should I buy a bunch of 10K? But oh, okay, but no, buddy, I'm not gonna help you do research on Gari, man. I don't know what that is, and I don't particularly care. I mean, I care about these assets here. Oh my god, Ethereum's up 10%. There was news today that Ethereum is getting an SEC investigation out on them that they are a security. Um, way back when, I also believed Ethereum is a security, and really, to an extent, I still believe that Ethereum is security because they did the whole fork thing that created Ethereum Classic. They essentially are sometimes managing what transactions need to be reversed or not. They are doing some interactions on who gets their money back and who doesn't on Ethereum. So I think the other argument I saw is everything was quote unquote fine when they were proof of work, and now that they're proof of stake, that's not helping their case in trying to prove that they're not a security. It's an interesting situation because it's guilty until proven innocent sort of situation here right now with Ethereum. Bitcoin is up 9%. Yeesh. Everything is doing well in crypto, but also a lot of things are doing well in commodity land, like gold. Gold's probably going to go all the way up to the end of the month. A lot of these assets, I think, are going to go up next week and into the end of the month. My general view for a lot of these risk on assets is that any positive momentum into the end of this week is likely to simply carry on into next week. It's a very naive expectation, but don't confuse naive with, quote unquote, stupid / simple. Naive is just another word for consensus, nominal. I mean, you can use the word simple as a synonym for naive, don't get me wrong. But in mathematics, naive is just like, okay, let's just go over like the basic view. And that's generally how momentum autocorrelation stuff works. It's like, hey, if you have momentum right now, the likelihood is that momentum's likely to continue, which was the entire reason why here we set our expectation for the month up here. And once we reached this price on the monthly charts we were looking at here on gold, we drew this chart here back in February before the run up. And then once we hit the spot in the first 2 days, we're like, well, this momentum is super strong. We see all the CTAs are very long momentum right now, and this is a really strong sign that momentum is likely to continue. So we need a higher target. And we looked at some quarterly expectations, and we found this area around 2200, just below 2200. So we drew this box here, and we nailed that. And then we set expectations for maybe a bit more up, but net end of week down, a bearish week. And don't get me wrong, it wasn't pinpoint price accurate, but we got the general theme right. Topping somewhere around here and just down later. This was a nicer view though. So this was last week's expectations that we set, which was, hey, down somewhere around here and then up into end of the week. And this is a big, the expectation was exceeded definitely today here on gold. FYI, if any of you guys want me to pull up a specific asset, and I'm not pulling up Gari, sorry, crypto man. But if you guys want me to pull up a particular asset, absolutely. Now is the time to ask. Today was like somewhat ranty, but the streams are starting to pick up a bit more consistent viewers and watchers. And excuse me, I want to spend some of the time going over like, hey, expectations are important, reading outlooks are important. Aussie dollar. I think, yeah, I already pulled this one up. I went over exactly how I flipped on this, how I did the risk management on this particular trade, and I lost like 4 pips on it. Way better. Way better risk management. And now I'm currently holding long on this euro dollar here, and I'm not satisfied with the current amount of pippage I got on it. I really want this thing to do well when the flash PMIs come out, but then I can get into the 3 digits here on pippage. And I know that's not usually what people say when they relate to pips, but okay, whatever. I make up words. We have a little fun around here. Dollar CAD was interesting. You can see this is another scenario where we expected up and then down. Down expectations, the closing expectations have definitely been exceeded so far. The yield spreads, let's just go to a daily yield spread here, are just flat. Long term, there's still green, so maybe there's a bit of a hold up around here. But I would expect by the end of the week, I would think that we close below 135 here on the dollar CAD. But yeah, that's kind of interesting, huh? Hey, if we start trading above this thing, there's risks of going a lot higher. And we didn't end up doing that, and FOMC came out dovish. Interesting. There was a big fuss actually here on the pound yen, because this thing just went crazy the last 2 days, and you can still see that the yield spreads are real bad. The UK ain't doing so hot, but the yen got so weak. Same thing with the pound, with the euro, same thing with the CAD. Just the yen got so weak. Not against New Zealand. New Zealand is kind of lagging here. Actually, if you even go to New Zealand dollar, it didn't even do so well here on FOMC. Oh, we set this up quite a while ago. Man, I wish I actually did take that one. Crap. I think I might have forgot to set an alert on this one. I actually would have taken that if I got alerted. Oh, I feel like I missed out. But you can see expectation got met. We got our red expectation March 15th. I don't know if you guys can see that clearly or not, but we have our red expectation and our green expectation. I don't think we're going to reach these prices by the end of the week, but this closing expectation does seem reasonable to me. And I believe this drawing right here is actually a monthly expectation, if I'm not mistaken. Yeah, check that out. 38% of the time for the month of March for the last 21 years. The low is between the S0.5 and S1 pivot, somewhere in this 50-point range. So we set this expectation twice, actually, way back here on the last trading day of February and here at the beginning of last week. So again, these yield spreads are really bad right now still. I'm not totally sold on that, but I probably would have taken a shot there if I had an alert set up. I should probably bring up ES. Usually people bring up ES. Again, this has been a phenomenal day for the S&P and a phenomenal day for the NQ. Man, I know like so many people who done well today. So many people that I've talked to today have done well today. But you always have to keep in mind that there were people who did not do well today, and not necessarily, guilt trip yourself into like, uh, what is it? Uh, Not survivorship bias. Um, Maybe that is the right term for it. But don't try and guilt yourself because you did good. If you start thinking about all the people who probably lost money today because they were thinking that the FOMC was going to be hawkish or a bad event, just think, why did those people not make the right expectation? What were they thinking? What were they reading that misinformed them? So that then you can defend yourself against similar patterns happening to you. Don't study people's failures to put them down or pity them. Like, I have a take on Jesse Livermore, that he is the epitome of how not to be a good trader. Like, his whole life, like, sure, he did well trading for a time, but the guy ruined his life pretty much with trading. He ruined his life. And it's important to, it's like the whole idea of people who idolize anti-heroes in movies, that sort of stuff. It's like, oh, or the people who are more recently are watching the Dune movies and saying, oh my god, Paul is such a good guy. Not knowing what Dune Messiah is about, or who Leto the Second is. Dune is a story about worms. Sorry if you don't get the reference, but there were no spoilers there in what I said. If you're like really into Dune and you're just getting into it, yeah, like recently, all these people are saying, "Oh, Paul Atreides, da 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 da, what a cool guy." Like, not the point. It's not the point. You're not supposed to take that message away. You're supposed to see why people are making bad decisions and learn from them so you don't repeat them yourself. And try and not be judgmental against the people who are making that mistake. Like, even though I said just now a little bit of harsh words about Jesse Livermore, I am really kind of indifferent. The guy had his life a long time ago. He has left a legacy for a lot of traders. He has inspired a lot of people to get into trading and try and find financial freedom through that, even though he was the kind of the first guru who sold technical analysis courses the year before he committed suicide. Yeah, some of our most deep-rooted problems here in 2022 with the trading community come from a guy in like the 19 who died in the 1940s, something like that. Yeah, Sand is course. It's funny how that Star Wars quote has just transcended from cringe to being a fond thing people think about. So yeah, positive momentum into the end of this week. I think baseline is going to lead to some more positive drift momentum like stuff into the following week. A few assets still have economic events coming out into the latter half of this week. We'll have to see how they perform. I have my eyes on European flash PMIs specifically because that's just something I have exposure to with the euro dollar. But European equities flat also have exposure to that stuff as well. And it's gonna, I'm really interested in seeing how those German flash PMIs actually turn out, because I want to know how the sick man of Europe is doing right now. Hopefully, the world is on track to recovery. And the Fed and every single central bank is wrong about the amount of unemployment we need to drive in order to get inflation and wages at a level that businesses are okay with growing again. And we don't have to force the quality of life in the world lower in order to be prosperous. Anyways, on that front, I'll go ahead and say thank you guys for watching. I'm going to end the stream now. I'm also not going to be on Discord for the rest of the day. I'll be on tomorrow. So if any of you guys want to hang out, you can go to the WAP store. And there's actually a link in the WAP store to. That's how you get into the Discord. You go to the link at the top of that description. You click on that. There's a Discord invite there. And you can get access to these indicators and one-on-ones in the trading group that I'm talking about. Alrighty. I will see you guys in a bit.